Hello, everyone. My name is Ariela Wagner. I am the founder of SunRay Construction Solutions, a national preliminary notice lien service, helping subcontractors and suppliers throughout the United States. Today, we have another extraordinary webinar, the 6 most important tax provisions of the CARE Act for construction companies. Today's speaker is Mike, and Mike is a CPA, is a tax partner with the top 25 firms of, I'm going to start that over again because he's too extraordinary to ruin his introduction. Mike DeSiato, a CPA, is a tax partner with the top 25 accounting firm of Sherry, Bekaert, and is an executive member of the firm's real estate and construction group. Mike has spent over 40 years working with construction companies and their owners, helping them identify and implement effective tax strategies to increase their cash flow, improve profitability, and build enterprise value. So today, if you have any questions after the webinar, if you can use the chat box on the right, we will answer all the questions that we can. So today's agenda, and without further ado, I introduce Micheal.
Thank you, Ariela, and good morning, everyone, and welcome to today's presentation. I hope everyone is doing well and staying safe in these very extraordinary times. And I would like to, again, thank Ariela and her team for making this presentation happen. So today, what am I going to do? Well, I'm going to try and I'm going to review with you all how you guys in the construction company and the construction industry can monetize the major tax incentives that are embedded in the recently enacted CARES Act. So to that end, I'm going to cover 6 of the most important tax provision of the CARES Act for those of you in the construction industry. But before we go to those issues, let's talk a little bit about what CARES Act means. So next slide. There you go. Okay, so what is CARES anyway? Everybody's talking about the CARES Act. Well, CARES is an acronym for the Coronavirus Aid, Relief, and Economic Security Act, signed by President Trump into law on March 27, 2020. It's a $2.2 trillion economic stimulus package that is the 3rd phase of the federal government's emergency legislation to deal with the COVID-19 crisis. Now, just so everyone is aware, there is a 4th round of legislation that's currently being considered by Congress that would provide up to $250 billion more in funds for small businesses, primarily through the Paycheck Protection Loan Program. But unfortunately, as of this point in time, the legislation is caught up in the politics of Washington, D.C. But stay tuned. Hopefully, there'll be something coming out of that. Okay, next slide. Okay, let's start off with the employment tax relief provisions of the CARES Act. There are 2 relief provisions here. One is a tax credit and one is a deferral program. So let's start off with the employee retention credit. So at a very high level, this credit, and it's a credit against the employer's share of payroll taxes, is equal to 50% of qualified wages up to $10,000 per employee. So if you do the math, that's a $5,000 credit per employee for wages paid after 3/12/20 through the end of this year. Qualified wages includes not only the actual cash wages, but also includes healthcare costs that you pay on their behalf. But it does not include any paid sick leave or extended family and medical leave provided for under the Families First Coronavirus Response Act, which is the FFCRA, because those wages have their own separate tax credits. Qualified wages are paid by you personally, by your company, but they can also be paid by a PEO or a payroll company that you hire on your behalf. Okay, let's talk about who qualifies. The qualification is very, very broad here. It really is any company's operations were fully or partially suspended due to COVID-19, due to any type of governmental order. So that covers a lot of folks. And if you don't get covered there, there's also an alternative test, which looks at your gross receipts. So if your gross receipts during a quarter in 2020 were less than what they were, that were 50% of what they were for the same quarter in 2019, then you would also qualify. But that qualification will end once your gross receipts climb up to at least greater than 80% of what they were in the prior quarter. Now, for this purpose, gross receipts doesn't mean cash collected. Gross receipts means your revenues. So revenues are the amount of revenue you book in your books and of account. So it's not your collections, it's not your cash collections, it's the actual amount of revenue. Of course, if you're on a cash basis of accounting, then it would be your collections, but it's typically your revenues. Okay, now it's very important here to understand that when you do any kind of calculations here, you have to take a look at, and we're talking about gross receipts in this case, you have to also consider all entities that are under common control. That you have to treat all commonly controlled entities as one entity. So when you look at your gross receipts, you got to look at all controlled entities. And the other issue is your employee count. Your employee count is important because there's different rules as to what type of wages qualify. So if you are an employer with 100 or fewer employees, all wages paid are eligible for the credit regardless of whether or not the employee is furloughed. On the other hand, for those of you with more than 100 employees, only the wages paid to those who are not performing services are qualified wages. And again, when you do this 100 or more than 100 calculation, you have to look at your control group of companies to make that determination. You can't just look at one specific company in the group. Now, the credit here offsets, as I said, the 6.2% employer share of payroll taxes due, and can also be used to reduce your required payroll deposits. So that helps you with your cash flow. The big caveat here, and I'm sure many of you read this, if you applied for and got a payroll protection loan, then you cannot take this employee credit. Okay, so that's raised a number of issues. The biggest question I have gotten is, well, which one should I go for, Mike? Should I take the credit or should I get the payroll protection loan? Well, when the modeling that we have done in our firm almost always shows and demonstrates that the payroll protection loan is going to be more advantageous than the employee credit. And that's because under the payroll protection loan, as we'll talk about a little later, most of that loan will be forgiven. Okay, now let's move on to the last bullet point on this slide, the payroll tax deferral. That's another benefit that's in the CARES Act. So in addition to the employee retention credit, the CARES Act allows for the deferral of the employer share of the 6.2% Social Security tax that would otherwise be due in 2020 until the end, 50% of which will be due at the end of 2021, and the other 50% can be paid at the end of 2022. So that's quite a substantial deferral of the payment of payroll taxes. Now, there is an interaction with the payroll protection loan here as well. So if you get a payroll protection loan, all is not lost here, however. You could still take advantage of this payroll tax deferral, but the payroll tax deferral will end once the loan is forgiven. So once you get that loan forgiveness in place, then all those deferred payroll taxes will become immediately due. So you don't get the 2-year spread, it all becomes due. But at this point in time, if you just got your loan, it's going to be at least 3 months before you get payroll tax forgiveness. You get payroll protection loan forgiveness. So you could defer your taxes for at least 3 months at this point, which again, it helps you with cash flow. And the key takeaway here, I would say to most folks, is if you're not processing your own payroll and you use an outside payroll company or PEO, call them, get a hold of them, talk to them about this. I know they're all set up to help you take advantage of this. So get in touch with them so they can help you navigate through this. Next slide. Okay, all right, good. All right, so let's shift away now from payroll taxes. Let's get into some income tax savings. Okay, the excess business loss limitation. This provision could have an impact on those construction companies and your owners who operate as either an S corporation or LLCs treated as a partnership. Okay, so under the Tax Cut and Jobs Act, which was the major tax bill that was enacted at the end of 17, starting in 2018, pass-through losses from S corporations and LLCs were limited for use by their owners to up to $500,000 if they filed jointly, or $250,000 if they were not married. And that limitation was the maximum amount they can use of those losses on their personal returns to offset other income. The losses that were not utilized and became suspended here became net operating loss carryforwards, and can only then offset up to 80% of future taxable income. Now, what the CARES Act did here is it basically removes this business loss limitation for 2018, so it's retroactive through 2020, so that losses in excess of $500,000 or $250,000 are now allowed in full. Okay, so what are the key takeaways here for you? Well, first of all, if you look back on your 2018 return and these losses that were coming through from your pass-through entities were limited, then you have the opportunity to go back and amend that return to take full advantage of those losses, which could result in a tax refund. For 2019, if you haven't filed your return yet, don't forget that you're not limited any longer with regard to these pass-through losses. You could take them in full. And when you do if you go back and you look at and you amend your 2018 return, or when you prepare your 2019 return and you can take a full advantage of these losses, you may create a net operating loss. And we're going to find out in a couple seconds as to why that's important, because those net operating losses that you would create can now be carried back 5 years. Next slide, please. So speaking of net operating losses, let's talk a little bit about what the CARES Act did and changed with regard to net operating losses. Now, before we get into this a little bit, I want to make sure everyone understands that a net operating loss, which is essentially the excess of your business deductions over your business income, is not limited to a corporation. Individuals can have a net operating loss. And most of the times that happens because they have pass-through losses from S corporations or LLCs. And as we've seen, those losses are no longer limited. And as a result, they could have negative taxable income, which in most cases could be an NOL or net operating loss. So it's important to note that. So net operating losses can be sustained by corporations, and they also could be sustained by individuals. So let's talk about the two changes that were done here by the CARES Act to net operating losses. And those two changes relate to two main areas. First is the carryback rule, and the second is the 80% of taxable income limitation. Okay, so the carryback rule was changed. So for NOLs, or net operating losses, incurred in years 2018, so it's retroactive to 2020, can now be carried back 5 years, whereas before there was no carryback period. Okay, so that's very significant. You can monetize those losses by carrying them back. Of course, not of course, but you can also elect not to carry them back if you so desire. And also, NOLs in tax years 18 through 2020 can now be used to offset 100% of taxable income, whereas before they were limited to offset only 80% of taxable income. Okay, so let's talk about what are the key takeaways here for you. Well, one of the things we're telling our clients to do is to look at deductions or other tax planning strategies to generate or increase losses in 2018 or in 2019, and then carry them back for a refund. So let me tell you, and let me give you an illustration that is very pertinent to your industry. As you know, and I've been doing this for a while, you know, companies in the construction industry and we're telling people to do this, they can examine their accounting methods for both short-term contracts and long-term contracts, and they can make changes to them that can generate a tax loss. For instance, under the Tax Cut and Jobs Act, a contractor with average annual gross receipts of under $26 million could elect to use either the cash method of accounting or the completed contract method of accounting for all their contracts. So if they did this change and it was an automatic accounting method change, that change could result in a tax loss in the year of change. And if that's the case, and you do generate a tax loss by doing that, now under the new NOL rules, those losses can now be carried back for 5 years and result in a refund. Unfortunately, it's too late to do something like that for 2018 because that year is closed. But if you haven't filed your 2019 return, there are situations where you could go and ask for an automatic accounting method change in your accounting methods to see if you could, generate either a tax loss that you can carry back, or you can reduce your taxable income for 19 and consequently reduce the amount you have to pay for 19's taxes. Well, that was a mouthful. Sorry about that. I'll slow down a little bit. Okay, next slide. Okay, let's talk a little bit about the relaxation of the deductibility of the business interest expense rules. Okay, just to give you a little background here, under the Tax Cut and Jobs Act, taxpayers with average annual gross receipts of greater than $26 million were limited as to the amount of interest expense they could deduct. And the limitation here was essentially 30% of their EBITDA. And EBITDA is an acronym for earnings before interest, taxes, depreciation, and amortization. So that was the big picture limitation. You couldn't deduct interest in excess of 30% of your EBITDA. And anything that you had, any interest in excess of that 30% was able to be carried forward and it would be dealt with in the subsequent year. Well, what the CARES Act did is it increased that 30% limit to 50% for 2019 and 2020 for all entities other than partnerships. And this change, as you can see, could increase your deductible interest in either 2019 or 2020. Also, the Act also allows a taxpayer other than a partnership to use their 2019 EBITDA base instead of their 2020 EBITDA to calculate the amount of deductible interest. So how does that work? Well, for example, if your construction company had an EBITDA of $8 million in 2019, but let's assume that for 2020 you have a negative EBITDA because of what's going on today. Let's say you're going to lose money in 2020. What you could do now is instead of basing your interest deduction limitation on your negative 2020 EBITDA, you have the option and the right to go back and say, well, I'm going to use my 2019 EBITDA for that calculation. And 2019's EBITDA was $8 million. So 50% of $8 million is $4 million. So now in 2020, even though you have a negative EBITDA, you could still deduct $4 million of your interest. So that's a big benefit. And that additional interest could either, well, if you're losing money, it will increase your net operating loss. And as we just saw, those NOLs, that NOL in 2020 can now be carried back for 5 years and help you get a refund. Now, there was an election in this area that I think a lot of construction companies made to totally exempt themselves from this business interest limitation. And some companies did so because they didn't want to deal with it. So they elected out of it because they were allowed to, and they didn't want to have to deal with this whole limitation issue. And there was a cost to doing that. So if you made that election in 2018, there was a cost. And the cost that you had to pay was you had to depreciate all your real property assets over 40 years versus 39 years. Now, that's not much. So a lot of folks said, well, that's a pretty minor cost. So not to deal with all this stuff, I'll make the election and now I'm going to depreciate all my real property assets over 40 years. But there's a change in the law brought about by the CARES Act that I'm about to discuss that may make that election no longer optimal. And here's the reason why. Next slide. Okay, so let's talk about this. This is a significant change. This is something that everyone knew was a statutory drafting error. And when the Tax Cut and Jobs Act was enacted back in 2017, and the CARES Act fixed this drafting error that now allows qualified improvement property as property, well, the original drafting error was that a qualified improvement property was not eligible for 100% bonus depreciation. And that error was called the retail glitch. And the CARES Act basically changed that. So now the CARES Act says retroactive to 2018, if you put in service qualified improvement property, then you're now able to immediately expense that qualified improvement property, not have to set it up and depreciate it over 39 years. So what is qualified improvement property? That's the real question here. So at a very, very elementary level, qualified improvement property is non-residential real estate improvements to any interior portion of a building. Typically what we're talking about here are leasehold improvements or tenant improvements that were placed in service after the building was initially placed in service. So think about, you moving into into an office building, tearing out the interior and building new tenant improvements or leasehold improvements. Okay, under the Tax Cut and Jobs Act, you had to write that off over 39 years on a straight line basis. That wasn't the intention of the law, and it just was fixed now so that you now can immediately expense those improvements. But when you filed your 18 return, you probably, and you should have, written them off over 39 years. But now the CARES Act is saying, no, you can go back now and now take 100% bonus depreciation for that property. So what are the takeaways here? Well, again, as I just said, if you place qualified improvement property in service in 2018, you should go back and amend that return to claim the 100% bonus depreciation, which would decrease your taxable income and probably wind up getting a refund or reduce, you get a refund because you reduce your taxable income. Or you could create an NOL, and then, as we just pointed out, you can carry that NOL back for 5 years and obtain another refund. So go back and look, see if you have any of those things, and you have the opportunity to go back and amend that 18 return. Now, if you haven't filed yet your 2019 return, and you did put qualified improvement property in service in 2018, instead of going back and amending that return, the 18 return that is, you can request an automatic accounting change to claim the additional depreciation on your 2019 return. And again, this could reduce your income in 2019. It could create an NOL. And in both those situations, we're talking about generating refunds. So finally, the last takeaway here, and I started off this little discussion with this, is that if you were one of these contractors who made the election to not deal with this business interest expense limitation, and now you could take the 100% bonus depreciation on qualified improvement property in 2018 and 2019, you can go back and now revoke that election, because initially the election was irrevocable, but now the government, under the CARES Act and other guidance that has come out, allows you to go back and revoke that election and now take the 100% bonus depreciation in either year. Okay, next slide. Okay, so on the next slide, we're going to talk a little bit about one of the issues that's coming up now is hopefully most of you have applied for and have gotten your payroll protection money, payroll protection loan money, or you're in queue to get it. So congratulations if you've gotten through and you've gotten your money. Many of my clients have gotten it, or some of them have been notified they're going to get it. And now the issue becomes how to get much of that loan forgiven. So it's important to keep a couple of things in mind and points in mind here with regard to loan forgiveness. Remember this, the period for calculating the amount of loan forgiveness will begin 8 weeks from the time the loan is funded. So you gotta start, if you got your money, this next 8-week period is very critical. This is going to determine whatever you spend in this 8-week period is going to determine how much of that loan is forgiven. Now, here's what we tell, and we're advising most of our clients to do here. If you furloughed any of your employees and or if you reduce salaries, in order to get the full loan forgiveness, we're recommending that people bring back their furloughed employees at full pay or bring in suitable replacements and restore all payroll costs at the start of the 8-week period. And if you do that, you're going to have a very good chance of getting most of that money and most of that loan forgiven. Remember that you have to spend at least 75% of the loan for payroll costs, and no more than 25% can be spent on rent and utilities. And also during this 8-week period, make sure you gather and save all the documents necessary to support your payroll costs as well as your rent and utility bills. Okay, because the banks will soon be specifying and coming out with procedures that you're going to need to follow in order to get full loan forgiveness in the future. So stay tuned and stay in touch with your bank in this regard. Okay, because that's going to be important. Also note that after the 8-week period, and some people have asked me this question, after the 8-week period, you can go ahead and make payroll cuts without jeopardizing your forgiveness amount. Also, if you're down now and your revenue is low and maybe you're closed, if you reopen and revenues go back to normal in this 8-week period, that fact will not reduce the amount of your loan forgiveness. And finally, another thing you need to keep in mind, and this is a good thing, is that any amounts that are forgiven are not taxable income to you. So that's a good thing. And finally, the last thing I'll cover, and I'll open it up for some questions, is, and this is something, and that'll be the next slide, please. This is something that's hot off the presses. Yeah, the next slide. Okay, so this is hot off the presses. This is just something that came out well, not so hot. It's about a week ago, and things are changing very quickly today. But for those of you who are not eligible for a payroll protection loan, maybe because you have more than 500 employees, the Federal Reserve now is authorizing something called a Main Street New Loan Facilities for borrowers with up to 10,000 employees or up to $2.5 billion in 2019 revenues. So if you, and one of the conditions here is that your company must be created or organized in the United States with significant operations in and a majority of your employees based in the US. So this is another loan facility that you can access. It's not a forgivable loan. It's a 4-year maturity loan with a minimum loan size of $1 million with no prepayment penalty. So this is something new. If you haven't heard about it, please check out, call your bank and ask them about more information regarding this program, because the banks are the ones that will be lending this money. So this is another lifeline, if you will, for those of you who were not qualifying for the payroll protection loan. Okay, well, I said a lot. I said it fast, I think. It's 9:30. So I guess we'll open the floor for any questions.
Absolutely, great job. And we already have a question. So hold on one moment here. One of the questions that was asked are the tax deferral payable in the future.
Can you repeat that again? I'm sorry.
Sure. The question is basically, are the tax deferrable payable in the future? So it was probably pertaining to one of your earlier slides.
The payroll taxes, yes. So if you're talking about the payroll tax deferral, that's not a forgiveness, that's a deferral. So anything you can defer is going to be paid in the future. 50% of those payroll taxes, the employer share now, just the employer share, is going to be payable at the end of 2021, and the other 50% payable at the end of 2022.
Okay, great. Does anyone have any other questions for Micheal? Let's see, we have another question here. If taxes weren't filed in 2018, is it still qualified to receive the stimulus and benefits?
If taxes weren't filed, what do you mean the tax return wasn't filed?
I think so.
Oh, I think I know what they're referring to there. They're talking about maybe the individual rebate that everyone's been reading about, the $1,200 or the $2,400, because the IRS, maybe that's what they're referring to. I didn't cover that here, but I'll try to answer the question. So the IRS is going to look at whatever information they have to make that rebate. So if you file your 2019 return, they're going to look at your 2019 adjusted gross income to make that determination. If you didn't file in 19, they're going to look at 2018. And I guess the question here is, what if you didn't file in 2018, right? That's a good question. But if you haven't filed, then, you know, I think the answer is you should. So, you know, especially if you're under the threshold, right? So the rebates get phased out. If you're a single person, the rebates get phased out at about 99,000, start getting phased out over 75,000. And I think they're fully phased out once you reach $99,000 of adjusted gross income. But if your adjusted gross income is under $75,000 in 2018 or 2019, then you would get the full rebate. So you ought to try to file that return.
Okay. The next question, I have an LLC with no payroll, no W-2, and as an owner, I get a K-1. What's my best option here? Most of everything I hear is only for payroll.
They're probably talking about so maybe they're talking about the payroll protection loan because they have no payroll. So how do you get a loan for payroll if you have no payroll, right?
Correct.
So yeah, so excuse me. So in that regard, that you would be a self-employed individual in that instance, and you can apply under the payroll protection program as a self-employed person versus an employee, but versus, you know, someone who has employees. And the application is a little bit different. Well, the way you fill out the application is a little different. Instead of putting a number on the payroll line, you put essentially you would put your earnings, your net earnings from that business on the payroll line, and that's the basis for your loan. So if you're self-employed and you don't have employees, again, you could apply as a self-employed person for the loan, but your payroll number is going to consist of your earnings from that business.
Okay. One of our employees got hurt and is now starting to get paid by the workers' compensation insurance. He got hurt on 4/6 and we paid him until 4/10. His next check will come from the workers' compensation. Do we still qualify for the PPP?
So I guess they want to know if they can count that employee, and they're not, because they're not paying them, I guess, right? Because workman's comp is paying them. That's a good question. That's a good question. I can't say that I know all the rules around this SBA program, because that's what it is. So I would say I would be guessing. I don't know, but the best person to ask in that regard would be your banker. I'm sorry, I can't answer that. I'm not going to give you. I can't answer that question accurately.
Okay, and I think that maybe even that question, the banker may not have the answer, because the bankers unfortunately don't have a lot of knowledge of what's going on either. So I think the question we should probably have let's see if I could do a little bit more research for you. I know who asked this question. There probably are some other pending legal. This could also probably be a legal question as well. So let me see if we can get this answered for you, because I think it also could be legal.
Yeah, it's above my pay grade here. I'm mostly a tax person. This is not even tax related, although, you know, it seems to be a top of mind for most of our clients at this point is, how do I get my hands on this money? How do I figure out how to calculate my loan amount? It's really a very topical discussion at this point, although it's kind of waning now because a lot of people have submitted their applications. A lot of people have gotten funded. The fear now is that the program, which originally had, I don't know, $300 and some billion in it, is going to run out of money. And that's why, as I alluded to at the beginning here, there is a fourth phase of this Relief Act that's sitting in Congress. And part of that proposal, part of the bill, one of the bills in there is to inject another $250 billion into this payroll protection loan program, because I think it's going to run out of money based on its popularity and all the activity around it. I think there's a fear that it's going to run out of money. So hopefully our politicians could get together and and get this additional funding through, so we could get the money into the hands of the employers who need it to keep people on payroll.
We're going to wrap up this webinar. If anyone has any additional questions, you can see our contact details below. You may have another question that you think of throughout the day. Feel free to send us an email and we will be happy to answer you. As for the question and the final question that was asked, it's a very legal, I think, again, I have to speak with an employment attorney. It sounds like you still would qualify if you're paying him and you could show that, but it's not double. He can't basically double dip. So but I will get the answer because I'm not 100% sure.
Ariela, too, in that regard,
yes.
Let me know as well. I would be interested in the answer to that question as well.
Absolutely.
Thank you.
So my pleasure. So we have, of course, everyone knows the SunRay's wonderful online system. If anyone has any questions about securing their lien or bond claim rights, now more than ever, you want to make sure you're sending out your notices to owners. And if anyone has any questions regarding marketing, SunRay has a sister company that can assist you with all of your online marketing, any digital marketing that you may need. And with that, I want to thank you, Micheal. You did such a wonderful job. Thank you for educating the construction community on the CARES Act. And I wish everyone a sunny day.
Yes, thank you so much. Have a good day.